The Japanese yen fell sharply today, extending its downward trend due to a variety of causes. The fundamental cause of the yen's decline is the divergence in monetary policies between Japan and other developed economies, particularly the United States. While the Federal Reserve in the United States has raised interest rates to battle inflation, the Bank of Japan has kept rates extremely low to revive its stagnating economy. This interest rate discrepancy has resulted in a weakened yen, leading Japanese officials to intervene in the currency market to restore stability. Japan is considering selling some of its US Treasury holdings as part of its yen stabilization policy. Japan's Norinchukin Bank recently revealed plans to liquidate $63 billion in US and European treasuries to resolve unrealized losses on its balance sheet. This action, while substantial, is part of a larger strategy by Japanese financial institutions to manage financial risks linked with the sinking yen and different monetary policies in Japan and the United States. Why does Japan seek to sell off the United States debt? Several significant considerations have influenced Japan's decision to sell a portion of its holdings in US Treasury securities. Japanese financial firms, such as Norinchukin Bank, have suffered significant unrealized losses on their bond investments. By selling some US Treasuries, these institutions want to decrease interest rate risk while diversifying into assets with other risk profiles, such as corporate and individual credit risk. Norinchukin Bank, for example, intended to liquidate $63 billion in US and European treasuries to cover a net loss of 1.5 trillion yen for the fiscal year. The Japanese yen has been under considerable pressure, falling to a 34-year low against the US dollar. To support the yen, Japan's Ministry of Finance has intervened in the foreign exchange market, occasionally selling dollars to specified assets like US Treasuries and buying yen. This intervention is critical to averting further yen depreciation, which would raise import prices and lead to inflation. With the termination of Japan's long-standing negative interest rate policy, investment preferences have shifted. Rising domestic interest rates make Japanese government bonds more appealing to local investors than US Treasuries. This shift decreases the motivation for Japanese investors to keep overseas bonds, as they may now earn higher yields locally without incurring currency risk. Japan's economy faces issues such as stagflation and an aging population. Japan intends to improve economic stability and prosperity by reallocating investments from U.S. Treasuries to domestic bonds or other assets. This reallocation helps to manage the financial market's effects and guarantees that more capital is accessible to support domestic economic activity. Is Japan's action fueling the de-dollarization movement? Japan's intention to sell some of its U.S. Treasury holdings may have an impact on the value of the U.S. dollar and contribute to the broader trend of de-dollarization. Japan, one of the largest holders of U.S. Treasuries, may sell them, resulting in higher rates if bond prices decrease. This, in turn, might increase the cost of servicing U.S. debt and weaken the dollar's attractiveness as a reserve currency. However, the extent of Japan's sell-off in comparison to the whole market is key. While large, it may not be sufficient to collapse the dollar on its own. Japan's action is consistent with a broader trend in which countries are gradually lowering their reliance on the U.S. dollar for international trade and reserves. Geopolitical considerations, such as the United States' sanctions on other countries, have intensified this tendency, making nations apprehensive of over-reliance on the dollar. As a result, alternative currencies, such as the Chinese yuan, are increasingly being used in bilateral trade deals. Economic considerations also influence investors' unwillingness to retain U.S. Treasuries. High interest rates in the United States, spurred by the Federal Reserve's anti-inflationary policies, have increased the cost of dollar-denominated debt. This has encouraged countries to seek out cheaper borrowing options. Furthermore, the strength of the dollar makes it more expensive for foreign countries to hold substantial dollar reserves. If Japan decides to liquidate its holdings of U.S. and EU treasuries, this might have a substantial influence on both areas' financial markets. Let us take a little stop. Could you do us a favor? If you love our material, please click the like button. To help even more, Please share your views and criticism in the comments section. Your participation helps us grow. Thank you. Japan's sale of a significant percentage of its US Treasuries is anticipated to increase yields. This occurs because bond prices and yields move in opposite directions, so a sell-off would lead prices to fall while rates increase. This inverse relationship is a fundamental principle in bond markets, with selling pressure lowering bond prices and increasing yields. A large-scale liquidation of US Treasuries by Japan might cause major volatility in the bond markets. This volatility is caused by the quick flood of supply and the resulting market adjustments. Investor confidence may be impacted, causing broader changes in associated markets, such as equities and foreign exchange. Such market turmoil may spread as investors react to fluctuations in yields and evaluate their holdings. Higher yields on US Treasuries would mean higher borrowing expenses for the US government. This means that the cost of financing the national debt will rise, potentially affecting fiscal policy and general economic conditions. Higher borrowing costs may result in a bigger amount of the federal budget being dedicated to interest payments, leaving less room for other expenditures such as infrastructure, education, and defense. In addition to the direct repercussions, the sell-off may have an impact on global financial markets. For example, as U.S. yields rise, the attractiveness of U.S. debt to international investors may improve, potentially leading to swings in capital flows and currency values. Furthermore, higher U.S. yields may push other central banks to alter their monetary policies to maintain economic stability. Selling EU Treasuries by Japan is anticipated to have several significant consequences, comparable to those in the U.S. market. Here's a more detailed study using facts and data. Selling a significant amount of EU Treasuries would undoubtedly result in higher yields. This is due to the inverse relationship between bond prices and yields. A sell-off would push bond prices lower, resulting in higher yields. This was obvious in 2022, when the European Central Bank, ECB, tightened monetary policy to battle inflation, causing EU bond yields to climb from negative levels to more than 3%. Rising rates raise the cost of borrowing for Eurozone countries. This undermines the ECB's efforts to control inflation and boost economic development. Higher borrowing costs can put a strain on national budgets, particularly in countries with high debt levels, limiting their ability to invest in growth-promoting initiatives. Large-scale sales of EU Treasuries could cause instability in the bond market. Such measures might cause widespread financial instability as investors respond to fluctuating yields and review their portfolios. Large-scale sales may weaken the euro against other currencies. If the market sees volatility or a lack of confidence in EU financial stability, the euro may fall in value, hurting trade balances and economic performance across the eurozone. While EU-issued bonds from the SURE and NGEU programs are deemed strong and have high credit ratings, such as Adela from Moody's, a sell-off could expand yield gaps over German bonds. Despite the EU's higher credit rating, rates in certain maturities topped those in France and Spain. The forthcoming presidential election in the United States, which will include Vice President Kamala Harris and former President Donald Trump, might have a big impact on trade relations between the two countries due to their divergent trade policies and economic plans. During his previous administration, Trump prioritized decreasing trade imbalances and safeguarding American industry through tariffs and renegotiated trade deals. His administration slapped taxes on a variety of items, including those from Japan, to boost domestic manufacturing. If re-elected, Trump is expected to continue his protectionist policies, which may damage trade relations with Japan. This could result in higher tariffs and harsher trade terms, hurting Japanese exports to the U.S. and escalating trade hostilities. Kamala Harris is likely to take a more global and cooperative approach to trade, similar to the Biden administration. The Biden administration has tried to restore alliances and participate in international trade accords, highlighting the value of strategic partnerships. Harris is expected to continue this trend, advocating free trade agreements and lowering trade barriers. This could improve commercial relations with Japan, resulting in a more stable and predictable trading climate. That's it for this video. Thank you for watching the video. We sincerely thank you for joining us today. If our work resonated with you or inspired you, please consider showing your support by liking it and subscribing to keep connected with our community.